Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch this week. I'm Ntauleng Lechela, and joining me to unpack your stock-related questions today via Zoom is Mutooni from Sanlam Investments and Rowan Williams from Nitrogen Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time this afternoon. Let's start off in the US, right? There's been growing fears about a AI bubble. We've heard from, the IMF, the Bank of England sounding the alarm on that. What do you make of the concerns and current valuations, Rowan?
Yeah, so when you have a plethora of financial institutions starting to raise the alarm, you have to get concerned. I think what has driven this concern most recently is sort of the leg up that's been a result of some circular arrangements or transactions between the major players, driven by OpenAI, and first with NVIDIA and most recently with AMD in terms of committing to chip offtake. But importantly, taking investment in the business as well. So a lot of these top players are doing businesses with themselves. That's driving valuations higher. I think there clearly is demand, but at some point they're going to build more capacity than is required. And as a result, there's going to be overcapacity and demand will drop, particularly for the chips. And that will, I think, unwind a lot of these high valuations. So it does look very full. We have seen this in the past for those that have been around for long. The dot-com bubble, so where the sort of infrastructure demand is it preceded the demand and the build-out. And ultimately it was filled, but not without significant drawdowns in valuation. So for me, it does look a little bit like deja vu, and I'd be quite cautious, just holding or building positions at these levels.
And what about you, Ro? Is it a case of deja vu? Do you think a bubble is forming there? I mean, Rowan just spoke about, the money, the deal-making activity taking place there, really billions and billions flowing through into that industry from, the top chip makers to even the memory chip makers to some startups as well. What do you make of, activity playing out in the industry?
So I think Rowan captured it perfectly. And the only thing which I would add there is you have to look at two aspects of this. During the time when an industry is being built and demand is growing and everything, what tends to happen is you overinvest. But people pay their bills. So if you're making something for me, I order it from you, I pay you in cash, I borrow the money or I use my shareholders' equity to settle it, and the cycle continues. I think the most curious thing about what's happening now at this particular point in the cycle is all of these very strange financing deals that the customer is the lender, is the borrower. You can't quite tell who's who and what is equity and what is debt. And I think that's the difficulty that Rowan is speaking about. That is it just a feeding frenzy among themselves? Or is there really that underlying demand? I think the issue here is there's probably insufficient capital for the scale of investment that they want. There's not sufficient evidence that that scale is absolutely necessary right now, but nobody wants to be left out. You and I as investors have to be very careful. Every time society changes in this way, whether it was railroads or the car or even at the time of the dot-com boom, at that time it was fiber and cable in the ground. People invest massively, they go bankrupt. The guys who make money are the ones who buy these things out of bankruptcy. So a little bit of perspective needs to be applied here. This is not a race to the sky. And I think this is what's telling you we're somewhere close to the top.
And just on, not knowing who's who in the zoo, I came across a graph. I don't know if any of you have seen it, but a graph from Bloomberg that sort of traced out or mapped out how the money is flowing. And you just don't know where the money is going because it's coming here, it's coming out there, and you don't know who's the consumer, who's, it is quite confusing when you look at it in that terms. Let's move over to what's been playing out in the local markets, Rowan. While we have seen a pullback on the back of the pause in the gold rally, the oil share is still really, up. I think 30% year to date. And a question here on whether this is an opportune time to pick up some JSE shares, so the dealer behind everything.
Oh, right, yeah. So it certainly has been a remarkable rally, and I think what has been sort of specific about this market movement has been how concentrated it's been, particularly in the resi, and then more specifically gold and platinum shares. So it's been precious metals really driving the market, and that has been off of the back of sort of geopolitical uncertainty, Trump administration policies, and I think what we're seeing there is potentially that also peaking out and sort of starting to unwind in that the JC Inc. shares, like the JC, the operator,
yes,
and a lot of other South African businesses have lagged the market. And I think what we're seeing is potentially that picking up market slack as people start to rotate out of those precious metals and into those domestic equities. And one of those that is quite interesting, I think, is the JSE Limited, which is the operator of the local stock exchange. It has a monopoly. A2X hasn't made too many inroads into the market. It has had a particularly good trading year in that volumes are up, values are up, obviously traded, and to some extent, has lagged a lot of other sort of domestic equity counters that are exposed to financial conditions. So we saw also, importantly, a leadership change there. Dr. Leila Fourie is stepping down. Vivian Reddy's taking over. I think that's quite kind of positive in terms of continuity. A new CEO has been there for a number of years. And just sort of marks a continuation of the management team. The valuation does look appealing. I think their operating results are going to be very strong. They hold a lot of cash on the balance sheet. These are some of the companies, that you could rattle off a few others that have similar characteristics on the local market that I think is worth a very close consideration and is offering value here.
As Rowan mentioned, there's the succession plan intact with the next pick for the top job coming from the inside, has a monopoly on that exchange market in the country, and has managed to really diversify its revenue streams. Your view on that company, Roy?
Yeah, I think it's very well run. Remember, the problem they had before was they generate lots of cash, but their costs are out of control. They were very focused on the equity market, and and they'd gone through this whole software thing, which never worked out. But with Leila there and with her team, they've managed to streamline it into such an efficiently running business that it still spits out a lot of cash, benefits from the top line, benefits from market volatility, and they've got their fingers in all aspects of market activity. Valdine, I think, is a fantastic choice. She's basically she was a trader before. She's worked at the JSC. She's worked there through Leila's time, and I think she'll just carry it on. It's not expensive. It's a solid business. It's got a moat around it. I like it at these levels.
All right, looking at now JSE listed shares, Roy, in the telco space, there's a question on MTN and whether it is a good buy at these levels. Of course, there was a pullback in prices following that US DOJ probe, but operationally, it's managed to recover in key regions like Nigeria. That tariff hike also working in its benefit.
I think MTN is undervalued at these levels. If you think about it, when the results came out, they showed quite clear market dominance or market leadership in Ghana, in Nigeria, in places like Cote d'Ivoire and Uganda. SA a bit of a struggle,
Yeah.
but not bad enough to be particularly concerned. So even if SA stood still, I think over the next couple of years, you're still going to see over 20% earnings growth. Then the DOJ comes out and it sells off by, was it $1.6 billion? I mean, there's never been a fine that big. So I think the market overreacted there with good cause. I mean, MTN's had quite a few legal things historically. But when I look at it operationally, when I look at the balance of probabilities around the investigations and everything, I think relative to its peers, it's very well priced. If you compare it to Airtel Africa, for instance, which is listed in London, Airtel Africa, in my view, is an inferior business, but is trading at a higher multiple and has weaker prospects into the future. So I think South African investors have probably been bitten a couple of times by things that happen with MTN, but
Yes.
this is probably not that time. I think it's relatively cheap. I think the earnings will come through. I think the story is a lot less complicated than it used to be.
And what about you, Rowan? Is MTN your top pick in the sector? Roy mentioning that, the group is facing some pressure in SA, but it's not the only one. Vodacom also facing pressure in SA. I think the only telcos counter still showing rapid growth in SA is Telkom. So, I mean, those dynamics at play, yes, but at this point, would you be dipping your fingers into an MTN or a Vodacom or a Telkom?
Yeah, so they are looking, I think, interesting. The valuations, as Roy pointed out, are not demanding. And I think what we're seeing is an improving consumer environment. It's taken a little bit of while. The South African operations of those three operators have all been under a bit of pressure, just because the consumer's under pressure. There's sort of been quite a lot of competitive intensity. Telkom actually seems to be doing a bit better in the mobile space, winning market share in the mobile data space. I think the MVNOs are also sort of weighing on the various operators. They've been taking quite a lot of market share. I think MTN's valuation is cheap. They've done a lot in terms of fixing the portfolio. So I think the valuation can go up as long as they continue to deliver operationally. We probably at these levels, I think, because of potential corporate action as well, like Telkom the most, it has strong assets. It has been delivering. They've announced that there are potential talks between MTN and Telkom. I think with the approval of the Maziv deal by the competition authorities as it related to Vodacom and Remgro, that opens the door for corporate action between Telkom and MTN. So I think you've got that optionality with potential dividends as well coming through. And just from a valuation sort of deal perspective, that's probably our preferred pick. But they all look, I think, reasonably valued here.
I want to gauge your appetite when it comes to new entrants in the telcos space. Roy, just your sense around, I guess, that potential Cell C IPO that we could get, and whether there is appetite for, new entrants on capital markets for these players.
Look, we always appreciate new listings. They give, especially listings that give diversity or read-throughs across into industries. So Cell C will give you a different view. So when you look at the current listed telcos, you have Telkom, which will tell you about fiber and the SA market is an MNO and CapEx and all of that. MTN and Vodacom, who tell you a lot more about Africa and everything. What Cell C will show you is around how this MVNO CapEx-like strategy works, how you can exist as a telco without spending too much money when you're roaming on the excess capacity of others. So I think from that perspective, that's definitely interesting. Remember, if Cell C does list, then that releases Blue Label to be a standalone platform company on its own, which is also interesting. I mean, their stories have been linked together for a very long time, and I think people have ignored the true value of Blue Label as it stood ex-Cell C. So list Cell C, Blue Label starts looking like a proper platform business that should have a mid-teen multiple attached to it, whereas Cell C gives you a good picture into the MVNO industry, into a CapEx-light model, and how that can work locally. So I think it's always interesting, always attractive. Value valuation is everything. And I think both institutions and individual investors will be hard-pressed to ignore a listing such as that.
And how would you play that potential Cell-C IPO, Rowan? Is it competing with the likes of a Vodacom, a Telkom, or an MTN, or is it really competing with the banks, right? Your Capitec Connect, your FNB Connect. I think even ShopRite has exposure to that market as well.
Yeah, so I think it mainly competes with the other mobile operators in that it's an alternative provider, and I guess it's an enabler for those banks that you mentioned to provide those MVNO services, which are taking market share from the mobile operators. So, yeah, I think that's how you would see it. It's interesting. It's a little bit like, I guess, the Boxer with Pick and Pay. You could get exposure to the Boxer listing, if not directly via buying Pick and Pay before the listing, and hopefully get some sort of share price appreciation in the run-up to the listing. The same would be Cell-C, but that, to some extent, I think Blue Label's already discounted quite a lot of that in the share in terms of the anticipation of that value unlock on that listing, but it would be a way to play it. There's another interesting opportunity, Optasia, which is also a new IPO that is coming out of Ethos Private Equity. It actually provides sort of micro lending into the telco environment, providing airtime lending and other sort of micro lendings off the back of mobile operators. So that's an adjacent play, which would be more like a fintech play, which may be somewhat of a competitor between both the banks and, I guess, the telcos. So some interesting opportunities come up. I think it's an indication that the market's starting to get healthy again, and we're seeing new companies coming to the market.
All right, let's look at some of the smaller players on the JSE. And just sticking with you, Rowan, is Clientele a good investment? The viewer noting that it's also been on an acquisition spree. I think last year it acquired One Life, and sometime this year it deepened its exposure in the funeral cover segment with the acquisition of Emerald Life.
Yeah, I think Clientele's a company we don't speak about much, but it's a quality player, more of a sort of a direct-to-market network marketing model for distribution of life insurance, but has produced solid results. The share has performed nicely. I think from an institutional perspective, there's not much liquidity there, but from a small cap and sort of private investor perspective, I think it is worth a close look. As you pointed out, they've been redeploying capital into new acquisitions and broadening their market exposure, which I think is a positive thing, so good allocators of capital. And I think it should continue to compound. We have seen strong market conditions for the life insurers, partly because the bond yields are coming down, and equity markets have been strong, which also drives their returns. So, and I think that the sort of pressure on the consumer is going to ease. The low-end consumer has been healthier, which is where they play as well. So overall, it's a good package, and I think is worth a close consideration.
So there is another question on a smaller cap player, that being Jubilee Metals. The viewer basically asking about a good gamble on copper. So we'll perhaps look at that then, where we can get exposure when it comes to copper on the JSE, Roy.
Copper is interesting. I wouldn't go for the small caps, to be honest. I think, remember, developing a copper mine is a long-lived process. It takes years and years to build the mines. There is inherent demand. There's inherent mismatch between supply and demand right now, so the price is positive. I would rather just do it. If you look at Anglos ultimately are going to be a copper player. Big, well-capitalized, multiple jurisdictions. Rather stick to one of those. I mean, if I did look in detail at Jubilee or any of the smaller ones, maybe I'd have a better grasp of what exactly they're doing. But remember, they'll be very concentrated, and you'll be limited in your diversification based on geography, the different mines and stuff. Stick to the big cap. This one's giving you a huge amount, good access to capital and good access to to good minerals. So no, for that I would just stick to Anglos for the time being.
And Anglo, of course, merging with Tech Resources, also making it a bigger player in that copper space. What about you then, Rowan? Would you then be going into the diversified miners in making a play on copper?
Yeah, I agree with Roy. I think that's the best way to play it. So I think the copper sort of theme is a good theme. So then you want to say, how can we express that in a sort of lower risk way that we're actually capturing the opportunity? Anglos as mentioned. Glencore also has a strong exposure to copper. There are some more pure copper plays on the LSE, for example, Antofagasta, which is big operations in Chile and South America. So those are considerations. Even say a copper ETF would be interesting. The problem also with these smaller players is there's execution risk. So, you know, the individual mine, it's much more concentrated. So you just pick up extra risk beyond sort of normal mining operation risk, which I think, often, you know, more often than it's just more sort of binary, the outcome. So I think you want, as an investor, to have a more certain outcome, and the bigger diversified players are a better way to do that.
And that makes me think of, you know, Orion Minerals that's really been struggling, from exploration into becoming a copper producer, constantly tapping shareholders for further funding to, you know, fund some of its execution strategy. That brings me to my next question, right? Sticking in the commodities space, gold. It really is glittering, hitting the $4,000 record high earlier this week. And many viewers have been asking, right, whether it is the right time to pick up some of these gold counters. On the back of the hike we have seen in some of those gold players. Roy, a question that has come through this time around is not necessarily whether they should pick up gold, but rather whether it's the right time to book some profits.
Nobody ever got fired from booking profits. Let's start from there. I mean, the price has moved dramatically, both of the shares and of the commodity. It's justified. So the commodities moved because of geopolitics, balance sheet risk, debasement, all of these things that we've heard. But it's basically doubled over the last 12 to 18 months, give or take. A rational investor would take money off the table just because they've made the money as it is. When I look at the distinction between the stock and the commodity, remember the stocks give you leverage on that commodity price, but also gives you operational risk. And what you're betting on is the ability to generate cash flows. So right now their costs are relatively low because the price has gone up that much faster.
Yeah.
But what tends to happen with these mining companies is their cost of extraction increases. They become a little bit lazy. They go buy other mines. They want to do interesting things. And that reduces their profitability as their valuations go really high. So you're getting to that point now where you start thinking about how much more can there be within these businesses. On the commodity itself, the stuff that's moved the price is still valid. All these governments are looking bankrupt. There's a lot of money printing that could come. So that price could keep going up. But that's a longer-term trend, and it doesn't mean it will go up in a straight line. So taking some money off the table, buying the dips as it comes, buying as you get more and more information, I think is what the rational investor should be doing, rather than taking a one-off bet that says, this thing's going to the sky, I'm going to hold, and let's keep going.
Okay. All right, then what are you holding at the moment? What are you dipping your fingers into? Where are you seeing opportunity at the moment? Let's get into your stock pick, Roy.
I like Bidvest. So when the market is rallying and it's commodities and everything, one of the things that you also should look at is the stocks that have lagged. So Bidvest, great quality company. I think the market sold it off because they've made quite a few acquisitions over the past 3 years. They're highly indebted right now. But they've said, We've made these acquisitions. It means we've created a big international business. Over the next 3 years, we're going to pay down our debt, we're going to consolidate this business, and we're going to have the world's biggest hygiene business. It's trading at like a 20 or 30% discount to its long-term average. This is a business that has a reputation for generating cash, not spending too much on capex relative to turnover, and being very shareholder friendly. So I think at current valuations, you have very limited downside risks. It may take a little bit longer than I think for profitability to come through, but I think the patient investor will get rewarded there with increasing returns over the next 18, 24, 36 months. It's one of those sleep well at night stocks when the market is as volatile as it is right now.
And what about you, Rowan? What are you hanging your hat on this afternoon?
Yeah, we still like South African banks, and we're picking FirstRand. It is one of the quality South African players of the big four banks, the highest return on equity, at least of the big four ex-Capitec. And it remains very well positioned for improvement in economic conditions in South Africa. It's got a very strong franchise. The share has lagged somewhat, partly because of this UK motor conditions commission scandal and the remediation fine that they're going to have to pay. I think they've largely provisioned for that. I think the number, the quantum sort of is quantified. I mean, might be slightly bigger than their provision ultimately, but that overhang is going to move away from the share price. And as we see improving economic conditions in South Africa, the banks are going to continue to do well. The valuations will start to pick up, and I think it's a solid bet for, a recovery in South African equities off the back of improving South African conditions.
All right, gents, we have to leave it there. Thanks so much for your time and sharing your insights with us today. Now, that was Mutooni from Sanlam Investments and Rowan Williams from Nitrogen Fund Managers. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.